Ever wondered what happens to your investments if a trusted U.S. financial company hits financial trouble? Let's break it down. Welcome. Every day, I break down personal finance questions asked on Stack Exchange, highlight the community's best answers, and sprinkle in some actionable takeaways. If you're into learning a little more about money each day, make sure to subscribe to the channel. Now let's dig into today's question. Today we're exploring a common question. What happens to investments if a financial services company struggles? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So, to sum it up, this person is trying to figure out how a company like Fidelity might handle problems in the U.S. economy. They're thinking about whether investing in U.S. multinational companies could be a smart move to protect their money. They've noticed that Fidelity did well during tough times like the 2008 financial crisis and the 2020 pandemic. Investors who didn't panic seem to come out better. Now they're considering if diversifying with non-U.S. companies could be a good idea. They're curious about how Fidelity and their investments might be affected if the U.S. economy hits a rough patch. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's explained that investments can include stocks, bonds, mutual funds, or ETFs, all of which fluctuate with market conditions. While economic downturns can impact their value, recovery is often possible. Diversifying, even internationally, helps manage risk and guards against downturns. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. All right. Now that we've seen what the community had to say, here's our take on this question. It's a smart move to diversify investments across various asset types and regions, which helps cushion the blow if the U.S. economy hits a rough patch. Picking a reliable financial company, like Fidelity, adds a layer of security since they have a history of managing through tough times. And remember, keeping a long-term perspective helps weather economic ups and downs better than panicking and selling off. In this video, we've covered how diversifying investments globally can help reduce risk during U.S. economic downturns. Reliable companies like Fidelity often provide stability, and holding investments long-term is usually better than selling in panic. Plus, international investments might protect if a recession hits just the U.S. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.